Daniel thought he had won. After weeks of comparing lenders, checking rates every morning, and reading mortgage forums late at night, he finally got the bank to lower his rate from 6.8% to 6.3%, 0.5% lower. The loan officer even laughed and said, "You negotiated harder than most people. We're basically doing this one for free." Daniel walked out of closing proud of himself. He told his friends he had beaten the banks. But he hadn't. Because before Daniel ever made his first mortgage payment, the lender had already made thousands of dollars from his loan. And most of it was invisible. A month later, Daniel's coworker Sophia bought a house too. Same city, same lender, almost the same loan amount. Yet over the life of her mortgage, Sophia would end up paying nearly $8,000 more than Daniel. Not because of her credit score, not because of bad timing, not because rates changed. The difference came from one tiny detail she casually mentioned during her first phone call with the lender. One sentence. That was enough. Because modern mortgages are built like layered financial machines, and almost nobody sees the layers. Most buyers think the interest rate is the entire game. It isn't even close. The real money is hidden underneath. Daniel spent nearly 2 years preparing to buy his first home. He saved aggressively, cut vacations, canceled subscriptions, tracked every dollar. By the time he started shopping for lenders, he believed he understood the system. And compared to most buyers, he actually did. He requested quotes from multiple lenders, compared APRs, asked about fees, read the fine print. When the first lender offered him 6.8%, he pushed back immediately. He mentioned competing offers, said he was ready to walk. A day later, the lender returned with 6.3%. Daniel locked it in immediately. He felt victorious. And technically, he did save money. On a $300,000 loan, even a small rate reduction can save tens of thousands over 30 years. That part is real. But here's what Daniel never realized. The interest rate is only the visible layer of the mortgage business. Underneath it sits an entire structure designed to generate profit in ways most borrowers never notice.
The lender's actual borrowing cost was far below the rate Daniel received. That difference matters because mortgage companies don't simply lend you money. They price your loan like a product, and the gap between their cost and your rate becomes part of the profit engine. Daniel thought he negotiated away the lender's advantage. In reality, he only reduced it slightly.
Then came the fees. The lender charged an origination fee, processing fees, underwriting fees, administrative charges, document fees, small amounts individually, large amounts together. Most buyers assume these fees reflect actual operating costs. Some do. Many don't. Because once the loan process begins, borrowers become emotionally committed. They've chosen the house, scheduled inspections, transferred deposits, started imagining their future there. At that point, very few people are willing to restart the process over a few $1,000s in fees. And lenders know it.
Sophia made a different mistake. During her first conversation with the lender, she proudly mentioned she planned to put 40% down. To her, that sounded like strength, financial stability, leverage. To the lender, it sounded like certainty. A buyer with lots of cash usually appears less price sensitive, less likely to walk away, more emotionally invested. Sophia assumed her large down payment would unlock a dramatically better deal. But mortgage pricing doesn't work the way most people think. Once borrowers pass certain lending thresholds, putting more money down often changes very little. So instead of improving her leverage, Sophia accidentally weakened it. She accepted more fees, did less negotiating, questioned fewer charges, and over time, those differences added up to thousands. But the biggest surprise came after closing. 2 weeks later, Daniel opened his mailbox and found a letter saying his mortgage had been transferred to another company.
new payment address, new account instructions. The letter described it as routine, and technically it was, because most lenders never intend to keep your mortgage. They sell it fast, usually within weeks. This is where the mortgage industry changes completely. To most borrowers, the lender appears to be making money slowly over 30 years of monthly payments. But that's not how the business actually works. The real profit often comes almost immediately. Your mortgage becomes a financial asset. It gets bundled with thousands of other loans and sold to investors, sometimes to government-backed entities, sometimes into mortgage-backed securities purchased by large institutions. And when that happens, the lender often earns another major profit margin, a margin borrowers rarely think about or even know exists.
Then there's servicing. Even after your loan is sold, someone still collects the monthly payments, manages escrow accounts, handles paperwork, and processes taxes and insurance. That servicing right has value too. It can be sold separately or retained for long-term income, which means your mortgage can continue generating revenue long after closing day. And there's one more layer almost nobody notices: escrow balances. Every month, homeowners send extra money for taxes and insurance. That cash can sit in escrow accounts for months before bills are actually paid. Across millions of mortgages, those balances become enormous pools of money. Tiny amounts of interest multiplied across massive volume become another hidden revenue stream. Small individually, huge collectively. That's why the mortgage business is so profitable. Not because of one giant fee, but because of layers. Rate spread, origination charges, closing costs, loan sales, servicing income, escrow balances. Each layer looks harmless alone. Together, they create a machine most borrowers never fully see.
And lenders test you constantly throughout the process. Not directly, subtly. During casual conversations, application steps, timeline discussions. Every answer helps them estimate one thing. How likely are you to walk away? Mention you already made an offer on a home? Your leverage drops. Mention your moving date is locked in? Leverage drops again. Mention you already paid for inspections? Even lower. Because the deeper you move into the process, the harder it becomes psychologically to switch lenders. And the industry understands that perfectly.
So what should buyers actually do? The strategy is surprisingly simple. First, shop multiple lenders before emotionally committing to a property. Not after, before. Second, compare the entire loan structure, not just the interest rate. A lower rate can sometimes hide higher fees. Third, question every charge, every line item, every processing fee, every administrative cost. Many are negotiable, especially when lenders know you're comparing offers. Fourth, read the closing disclosure carefully, not casually, carefully. Most buyers spend more time researching televisions than reviewing mortgage paperwork tied to hundreds of thousands of dollars. And finally, never assume a larger down payment automatically gives you negotiating power. In some cases, it does the opposite.
The biggest illusion in the mortgage process is this: buyers think the negotiation ends when the rate is locked. But that's only the visible part. The real business continues underneath, at closing, after closing, and sometimes for decades afterward. Daniel thought he beat the system because he won the rate negotiation. Sophia thought she had leverage because she brought more cash. Both misunderstood how the machine actually worked. Now, you don't. If this changed the way you see mortgages, subscribe for more breakdowns on the hidden economics behind everyday financial decisions. Because the most expensive financial mistakes are usually the ones nobody realizes they're making.